This channel's focused on high yield, usually more than 7%. So why would I make a video about SCHD, which pays just half that? Well, I love dividends, and SCHD has used a dividend strategy that has beat the S&P 500 for total returns over the past 10 years and the past 5 years. And if you throw JEPQ into the mix since inception in 2020, well, it beat that too. And SCHD managed to do that without any help from Apple, Google, Facebook, Microsoft, or Tesla. So today we'll look at how SCHD uses a dividend strategy to create market-beating returns. Now don't get me wrong, I like stocks like Microsoft and Apple, but they pay tiny dividends, and as a retired investor, I want lots of dividends. Now I've covered in previous videos how you can get double-digit dividends from tech stocks by using funds like BST or JEPQ. But I don't want to put all my funds into just a handful of companies, even if they're really good companies. Any individual company could fail, so I don't want to be too concentrated. SCHD offers diversification away from those big tech companies, and it pays double the dividend of the S&P 500. The key to SCHD's success is that its dividend strategy focuses on quality companies that grow their dividends over a sustained period of time. And I'll explain how it does this, but first, a quick disclaimer, I'm not a financial advisor, I'm just a retired investor sharing the research I do for my portfolio in the hope that it helps you do your research for your own portfolio. This is what gets me excited about SCHD. The dividends have grown from 12 cents per share per quarter to 70 cents per share per quarter since inception back in 2011. That's a 483% increase in just over a decade. The dividends do vary a little bit. It's not a perfectly straight line, but if you look at it on an annual basis, then the trend becomes very clear. Solid growth every single year. An interesting point is that one of the best years that SCHD's had for dividend growth was 2022, which we know was a terrible year for the stock market. By the way, a lot of the information I'm showing you comes from Seeking Alpha. I've had a premium subscription with them for about 6 years. There's a link in the description for a discount on your first year if you'd like to give it a try. SCHD's objective is to replicate its benchmark, and that benchmark is the Dow Jones US Dividend 100 Index. So to understand SCHD, you need to understand this index. The formula is broken down on pages 19 and 20 of this document, and I'll put a link to that document in the description, but to be honest, it's a little bit dry. So let me give you the short version. We start with the Dow Jones Broad Market Index, roughly 2,500 stocks. Then we subtract real estate investment trusts. These do pay high yields, but aren't really designed for growth and aren't as tax efficient, so they're out. Then we subtract stocks with less than 10 consecutive years of dividend payments. We subtract small caps, subtract thinly traded stocks, and then we rank the remaining stocks by 4 criteria with equal weighting. The first one is free cash flow to debt. That favors stocks with little or no leverage. Secondly, we rank by return on equity, and this favors stocks that produce high earnings relative to the funds invested by shareholders. Thirdly, we rank by yield. That's pretty self-explanatory. And last but not least, by 5-year dividend growth rate. And this is really the linchpin of the fund. Companies that consistently grow their dividends at a high rate tend to go up in value regardless of market conditions, interest rates, the economy, whatever. And the last step is that the top 100 stocks that come out of this ranking go into the index as weighted by market capitalization. Some minor details: there are caps to prevent any one stock or sector overpowering the index, and the index is rebalanced quarterly. The fees are just 0.06%, which is pretty competitive even for a passive fund. And when it comes to taxes, SCHD pays qualified dividends according to Simply Safe Dividends, which the fund manager, which is Charles Schwab, describes as tax efficient. The top 10 stocks in the fund make up a little over 40% of the fund. So if you're interested in SCHD, I do recommend getting familiar with at least these 10 stocks. They're mostly household names and they're reasonably diversified. They don't really have that much in common apart from being high quality dividend stocks. There are some tech names in there like Broadcom and Texas Instruments, but they're old school tech. And each stock that's in the fund has earned its spot into the 100 list based on some combination of those 4 criteria I just gave you. For example, Broadcom's yield is not that high, it's just 2.99%, but it more than makes up for that with a 5-year dividend growth rate of 29% per year. And by contrast, Verizon doesn't have that much dividend growth, but the yield is pretty generous at 7.12%, and it generates a high return on shareholder equity. My bull case for SCHD is pretty simple. The fund tracks an index that I think is well constructed. If you combine a 10-year history of dividends, a 5-year history of high growth of dividends, low debt, and high return on equity, it's a fairly decent predictor of success. And that's because dividends are paid out of the profits, or to be precise, earnings of the business. So the Dow 100 is effectively a group of companies that consistently increase their profits and then use some of those profits to pay out dividends. And the benefit of a dividend growth fund like SCHD versus another fund that focuses on growing earnings is that you're receiving cash every quarter, and that gives you a lot of flexibility. You can spend the cash without having to sell any shares, or you could reinvest the cash back into the fund, or you could invest the cash into another investment, and during a market correction, you're still getting paid. And in the case of SCHD, during a correction, you're not just getting paid, you're probably getting paid more than the previous year. Now, it's not really easy to make a bear case for a diversified basket of quality companies that generate constantly increasing dividends, but I'll give it a try. This ETF might not work for you if you're just generally bearish on equities overall. If you're highly risk averse and you're looking to avoid any volatility whatsoever, then perhaps earning 4 or 5% on treasuries would make more sense. And another group of people I could see not being interested in this fund are those that have issues with some of the individual stocks within the fund. For example, some investors might have issues with Coca-Cola because they make unhealthy drinks, or have issues with Altria because they make cigarettes, or they might not like, say, Broadcom because they think a recession is going to hurt semiconductor sales. So if you don't like some of the SCHD stocks, then of course you could always make your own version of the fund by looking at the full list of all of their holdings, deleting the ones you don't like. And I'll include that full list in the description. So when is a good time to buy SCHD? Well, over the long term, it hasn't really mattered. SCHD's price has steadily increased since inception. But over the short term, I look at the yield versus the historical average yield. And if you go back over the last 10 years, for most years, SCHD is averaged in the 2s. Historically, when the yield gets up over 3%, it attracts more funds, which then pushes the yield back down into the 2s. So right now at roughly 3.5%, the yield would indicate that SCHD is currently attractively priced. As you've probably gathered, I like SCHD's dividend strategy. I think there's value in owning a basket of high quality companies that constantly grow their dividends at a high rate. And there's no way that I could go through all the thousands of stocks and come up with a better list of dividend growth companies than SCHD could, and then rebalance that list every quarter. That's a lot of work. Adding SCHD to my portfolio reduces the overall blended yield. I don't really like that part, but I can accept the slightly lower yield because it reduces risk and it increases the dividend growth rate. And those two things help me sleep better at night. If I had to sum up SCHD in one word, I'd probably choose the word sensible. That wraps it up for SCHD. More armchair income coming soon.